Over in the mining sector, analysts are foreseeing increased merger and acquisition activity to take place in the industry. This is due to, among other factors, softer commodity prices and logistics issues. Smaller to medium producers are mostly expected to team up with the bigger fish in the industry in order to cut costs. Bruce Dickinson, partner at Webber Wentzelfor, joins us now with more insight. Bruce, thanks so much for joining us today. Now, before we get into M&A activity, just lay the ground for us. Local miners have had a tough time. We've seen a trend of falling profits in 2023. Walk us through some of the factors weighing on the sector.
Thank you for the invitation. There are a number of factors. I think one needs to distinguish, between Africa and South Africa, for instance. In South Africa, key issues are obviously around energy, around the logistics crisis that we faced. We all know those issues. But there's also been softening commodity prices. Mm-hmm. So effectively, mining companies are having to sort of relook at their asset portfolios. They're being pushed closer to the red. Other factors that are really intruding on their ability to be profitable, remain profitable, are things like the social and labour plans that they're being asked to implement. I think what we're seeing more and more is, local government failures and an expectation from mine host communities that mines effectively step into the shoes of the local municipalities. And I think we're seeing it from the DMR as well, is that there's this expectation that mines will in fact provide services that would otherwise be provided by government, which is just pushing up, the hurdle rates for mining companies. It's just getting more and more expensive. It's getting riskier and riskier. And a failure to address those social issues around the mines results in, social unrest, social discontent. Local communities aren't turning their discontent on the local municipalities, they turn it on the mining companies because they see them as the only ones able to deliver on those basic services that they require. So these are some of the sort of factors at play in terms of impacting on the mining industry, which is resulting in the larger players, as has been the case for the last sort of 15 years or so, re-looking at their portfolios and restructuring those portfolios. So there's been quite a lot of M&A activity driven by that, and you've seen the likes of Sariti emerge out of that. Strategic companies like Afrimat have done very well in this space as well, where they've seen those opportunities. So mid-tier companies sort of emerging in this space to take up assets that either the larger mining companies don't want, or can't develop or run profitably anymore, and or looking to the juniors who've acquired rights but don't have the wherewithal to develop those rights themselves. And so mid-tier players will see, I think, quite a lot more of that, the mid-tier players coming in and mopping up those kind of projects.
Now, we're seeing this M&A activity between these smaller and medium kind of companies, as well as the bigger fish coming in to acquire the smaller fry within the space. Now, surely this is taking place because those stronger commodity prices before allowed these companies to beef up their balance sheets. But with the softer commodity prices coming in and those falling profits that we're currently seeing, can they sustain this? Can they sustain this buying power that they currently have?
Well, I think we need to distinguish between what's going on in South Africa and what's going on in the rest of Africa. Mm-hmm. So if you look at South Africa, I think this year is going to be particularly difficult. Obviously, we've got an election year, we've got the logistics issues, we've got the power issues, which is driving the appetite to invest in commodities in this country down. There are opportunistic opportunities in the coal space. We've seen a lot of juniors get involved, very sort of small scale miners, etc. And certainly there's scope for some consolidation there, and you will see some strategic players coming in there. I think that the commodity traders in particular have been very clever in this space, where they're effectively looking to take control of the metals, the minerals. They're providing development financing to some of the juniors and so on in order to enable them to develop their mines. Likewise, I think you'll see some activity in the manganese space and potentially the iron ore space. PGMs, obviously, we have a difficulty with at the moment, and I don't see anybody with sufficient balance sheet to try and pick up some of the PGM mines that are being put into care and maintenance or being mothballed currently. Around us, there's a lot of investment. So we've been involved in a lot of the lithium deals in Zimbabwe, in Namibia, the graphite transactions in Tanzania and Mozambique, copper in Zambia and the DRC, iron ore in Guinea. And unfortunately, this has been a trend for some time. So there you're seeing new investment coming in, new capital coming in into those countries to develop those projects. And it's simply just bypassing South Africa at this point in time.
Bruce, just before I let you go, I just want to touch on the rush into greener metals, right? Are we seeing this, or is being a bit more or abiding to ESG principles the bet for most of these miners as they look at deal making in this kind of environment?
Look, it has driven a lot of the deal making. As I was saying, when I look at the sort of deal making that's happened of late, it's been the lithium, which has driven a number of the deals. It's the graphite, driven a number of deals. In South Africa, there's opportunity around manganese, for example, which is obviously a critical mineral. And we should be seeing some activity in that space. ESG is a big issue, and it's an added layer of cost, and companies are very, very alive to what their obligations are. Is that a factor in M&A? It's a factor in due diligence in terms of understanding ESG credentials of target companies and the like. And what the potential costs are if you take over that company, if it doesn't have great ESG credentials, what you're going to have to do, what you're going to have to spend to ensure that you increase those ESG credentials. So that's where it's coming in the M&A space, where we're seeing it. But in terms of the green minerals, it's happening around us. It's not happening a lot in SA. PGMs, for example, really need green hydrogen to take off, and that's some way away, unfortunately. For PGMs to become that green metal, one needs the hydrogen play to come off.
All right, Bruce, we have to leave it there. Thank you so much for your time and those insights. That was Bruce Dickinson, partner at Webber Wentzelfor.